Okay, I want to conclude our presentation on optimal portfolio choice. And essentially, we're going to talk a little bit about the theory about how this process has come to be, if you will, and then talk a little bit more about some applications. Eventually, we'll talk about a formula that an expected return of a portfolio is the risk-free rate of a portfolio plus the market risk of that portfolio, the business or the individual risk of that asset. So a portfolio is efficient if and only if its expected return of every other security equals that return or is less. So how do we identify an efficient portfolio? Again, you really can't identify one, right? You really can't look at a picture and say, oh, that is an efficient portfolio. This is a theoretical process. In theory, if you understand the statistics, etc., between two assets, you can create a graph that represents the efficient frontier. You can calculate, if you include some form of a risk-free rate of return, you can calculate a maximum Sharpe ratio. But in theory, that's how it works. In real life, that's not really the way it works. It's very difficult to identify specifically what we refer to as an efficient portfolio. So the capital asset pricing model helps us to try to identify these risky assets that could be efficient, right? So we want to be able to choose without knowing a lot of detail about all the assets. So the capital asset pricing model uses the optimal choices that investors make to try to identify an efficient portfolio. So it really kind of looks at this problem backwards. It doesn't look at a set and call that an efficient portfolio. It looks at what people choose, and then from those choices, it identifies an efficient portfolio. So the capital asset pricing model is a theory that tries to describe the risk and return of assets. There are three primary assumptions. There are more, but these are the most critical of them. The first one is that we have a competitive market. Investors can buy and sell all the securities they want without taxes or transactions costs, and they can borrow and lend at the risk-free interest rate. Now, most of that sentence doesn't describe the world we currently live in. This is a theory, right? So we need to try to describe the world with the least amount of variables as possible. Assumption 2, investors are only going to hold in efficient portfolios. If they can find them, those are the only ones that they would choose. They would never choose an inferior portfolio. Again, in real life, this doesn't happen very often. Number one, it's very difficult to identify an efficient portfolio, but most of the time we have challenges in choosing the things that we want to invest in. So we're not always going to choose maximum expected returns given risk. And finally, investors have homogeneous expectations. That is, if everybody has the same data, everybody will come up with the exact same conclusion, the exact same valuation of risks and returns. Now, what this does is it allows us to simplify the equations. So we don't need a variable that will describe every single person's investment choices, every single person's sensitivities to risk. So this allows us to say, look, there's only really one investor. And we all think alike. So again, homogeneous expectations, we're all going to want the same portfolio. The combined portfolio of risky securities of all the investors then have to equal that portfolio. In the end, then, if all investors demand an efficient portfolio, the supply of securities and the demand for the market portfolio have to equal the supply of the market portfolio. They have to be equal. And really that just says that in the end, if everybody thinks the same and everybody wants to buy the same stuff, the supply and demand mechanism has to be in equilibrium. When the CAPM assumptions hold, the optimal portfolio is a combination of the risk-free assets and the market portfolio. What does this mean for us? Basically, it says, look, there is a combination, there is a graphical representation between risk and return if the capital asset pricing assumptions hold. And we've seen this picture a little bit earlier. Here's the risk-free return. Here's the market portfolio. The capital market line is this light green line that represents the efficient frontier between the market portfolio and the T-bill rate. So again, that really doesn't help us making individual choices though, because we have all of these other assets. How do we know whether these assets are good investments or bad investments individually? How will we know when to buy or sell them? If we can move from this capital market line concept, if we start thinking about beta, systematic risk, we can melt these two ideas together, if you will. So if you look at, here's the capital market line, and if you look across, everything kind of lines up. That in a world of equilibrium, everything is going to fall on this line. In a world of equilibrium, all stocks will fall on this security market line that again describes the risk-return relationship. So again, let's kind of go through this one more time. Capital market line looks at all these portfolios. The risk thing that it's talking about is standard deviation. We know that standard deviations for portfolios is not the best measure, but the capital market line gives us an indication of the choices that investors will make based on risk and return. The security market line then moves from that choice concept to talk about the relationship between returns and the systematic risk. And it turns out that that is a linear relationship. If the world's in equilibrium, everything shows up on this line. So according to the CAPM, the market portfolio is efficient. So all stocks and all portfolios should line up on this security market line. So how can we find the beta of a portfolio? The beta of a portfolio is the weights of the betas within the portfolio. This is very similar to thinking about the weights of returns of securities that are in a portfolio. So here we have Kraft has a beta of 0.5 and Boeing is 1.25. Risk-free rate's 4%, the market portfolio is 10%. What if we put an equally weighted portfolio together? Well, if you use the portfolio beta and return worksheet, we can calculate the expected returns for the two assets. For Boeing, we would expect to get about a 7% rate of return. And for Boeing, we expect 11.5. If we put 50-50 in each one, again, we would expect to roughly earn about 9.25 is the return we would expect. And the beta of this portfolio would be 0.875. If you plug those numbers back into the formula, 0.82875 is the beta, 4% is the risk-free rate, 10% is the average return of the market. Again, this just confirms that this portfolio should earn about 9.25%. So again, we can utilize this beta to help us understand the returns, not just on individual stocks, but also on portfolios of stocks. So the market portfolio is the efficient portfolio. The risk premium for any security is proportional to its beta in the market. How we're going to discuss this moving forward is to think about, well, if you wanted to issue securities, what is a good price for those securities? The price and return are related to each other. If you wanted to build a new plant or have a new product line for a company, what rate of return should you expect to get? Well, if we can calculate the beta, the systematic risk of that project, we should be able to calculate the expected rate of return on that asset. So moving forward in this course, we're going to take this risk concept and we're going to start to apply it to securities. We're going to first start talking about corporate projects, and then we'll move to stocks and bonds. Look forward to talking to you in another video.